Good morning, and thank you again to those who have joined us. We're right at 10 o'clock now. We're going to give it about 1 or 2 more minutes for a few more people to trickle in, and then we'll go ahead and get into today's discussion. Thank you. All right, good morning, and thank you all so much for your time and joining us as we kind of peel back the curtains and take a dive into how at Traction Financial Partners we handle things in our investment committee and how those decisions relay and are incorporated into our client portfolios. My name is Drew Barnes. I'm the Director of Financial Planning here at Traction Financial Partners. I'm with Evan Barnes, who is co-founder and chief investment officer. He is also the committee chair for our investment committee. And we're very happy to have you join us today. So when it comes to the investment committee, really what it is it's the advisors here at Traction Financial Partners. And we have a dedicated committee to make sure that we are completing all the due diligence necessary to best be advising and helping our clients invest to meet their goals. And so the agenda for today, we're going to start off with what the role of the investment committee is, who all serves on the investment committee here with TFP. Then we're going to get into our investment philosophy, how we operate our monthly committee meetings. We'll take a look at our investment models, our buy list, watch list, and ideas list, how we go about making any changes to models or client portfolios, the economic data and measurements that we are always constantly tracking to make sure that we're in tune with everything happening in the economy and markets, tax management, and then we'll end with some unique ideas that we utilize here at TFP, focusing in on structured notes. So with that, I'm going to go ahead and kick it over to Evan, again, our investment committee chair, and he is going to kick things off by talking about what the role of the investment committee is.
Thank you, Drew, and thank you to everyone who's joined today. I think it's important that we are doing this. We get a lot of questions around, hey, how do you guys make decisions? How do you decide what funds to use? How to manage our money? So I think it's a really fun and entertaining way of, hey, here's a deep dive to show you kind of behind the curtains of how we operate. And to start off with, what is the role of the investment committee? We move forward one, thank you. So the role of the investment committee is to approve the firm's investment objectives, goals, and portfolio strategies. The investment department performs all the day-to-day work of developing and managing the firm's investment portfolios, whereas the investment committee is responsible for planning and oversight. So the day-to-day work of trading, rebalancing, if someone calls in and say, hey, we need to take a distribution, or hey, we have some money to add, the investment department is going to handle those day-to-day operations and activities. The investment committee, we're going to go into more here in a second, is responsible for planning and oversight of the whole operation when it comes to our investment management. And the investment committee functions best when we have a trusted working relationship between the investment department and the wealth advisors of the investment committee. This helps develop a cohesive approach towards investment strategies, and we'll be able to garner a consensus between the firm and its advisors to make sure we're on the same page. That's the important piece, of making sure that we are communicating to you what we as a firm, the investment community, the advisors, what we are, the reasons we're making changes, what we're seeing in the markets, the data that's driving what we're doing behind the scenes, making sure that we are very cohesive and making that available to the advisors to then communicate it to the clients. Here we are, the investment committee members. We're very fortunate to have such a impressive group working on the committee. Over 80 years of combined investment experience. You get myself, Bob Haycoop, who's the president and CEO, our wealth advisors, Randy Anderson, Shane Wolf. Drew introduced himself already, and then we also have Ryan McNamee, who's associate financial planner, does a lot of work for the investment committee, a huge addition that we added this year. So this is the team of 6 who is meeting on a monthly basis to make sure we're monitoring the investment ins and outs of the organization. So what is our investment philosophy? Here at Traction, we believe in modern portfolio theory, which is going to be on the next slide. We'll go more into that. And as part of modern portfolio theory, we also have the efficient market theory. Those two go hand in hand together, which we're going to talk about. And then also the core satellite approach, which hopefully we've communicated that to you guys as clients in meetings. But I think that these 3 components to our philosophy are key and crucial. We're going to talk more about what they are here, starting with modern portfolio theory. Modern portfolio theory, really, it's a practical method for selecting investments in order to maximize their overall returns within an acceptable level of risk. Asset allocation, broad diversification is something that we truly believe in, that over time has worked. And depending on our clients' investment objectives, their goals, what their plan says they need to do to accomplish their hopes and dreams and really fulfill what their financial plan is saying they need to do, we walk through a detailed process of coming up with these asset allocations that are driven by modern portfolio theory. On the right-hand side here, you can see the appropriate allocation among asset classes, stocks, bonds, cash, etc. There's many asset classes out there that we use. Having that appropriate allocation will have a greater influence on the long-term portfolio results than if we were sitting there selecting individual securities. We're not stock pickers. We don't pick individual stocks as part of our models. We have plenty of clients who do have individual stocks that we incorporate in their portfolios and build models around those, depending on their tax situation and why we have those stocks and whatnot. But internally here, we are not stock pickers. We believe in broad diversification through asset allocation. And asset allocation can account for more than 80% of a portfolio's returns. How we build your portfolios through asset allocation, that's going to have the primary impact of how your returns come out over time. And portfolio volatility can be decreased by enhancing diversification of the portfolio amongst these different asset classes, just diversification. How you diversify out can really help monitor how we are approaching risk when it comes to your portfolios and decrease volatility. We don't want a bunch of asset classes that are going to correlate exactly together, meaning that when the market moves up, everything's going to move up exactly the same. We want some asset classes that don't correlate, so that we can reduce risk in the portfolio while accomplishing your long-term returns and objectives. That's the basis of modern portfolio theory. Efficient market theory. In efficient markets, it is unlikely to beat the market with any kind of dependable consistency. And what we mean by efficient market theory is that many markets, U.S. large cap stock market, for example, right? There's the biggest companies in the stock market. Information is known so widely and so quickly. It's disseminated out that people understand and have an idea of what a stock is going to do. The information is out there to be known very quickly, okay, which makes the market very efficient. It's hard to sit there and pick individual stocks that's going to beat the market in an efficient market, such as the US stock market. So for those types of allocations in your portfolios, we favor passive investment strategies, okay? That's going to involve using exchange traded funds or index funds so that we say, hey, we want exposure to US large cap core stocks. That's going to be like the S&P 500. Okay, it's hard to sit there and consistently beat the S&P 500 by picking individual stocks. So why not just have direct exposure to the S&P 500 index? Okay, so in your portfolios, the vast majority of you are going to have an S&P 500 fund. Okay, so we have that exposure through using an ETF or index fund. It's very cheap and an efficient way to get access to those markets. There are less efficient markets, such as fixed income or bonds or international stocks and global equities, that you can find opportunities to outperform the market. Okay, so we use active managers primarily through mutual funds, and there are some actively managed ETFs. But if we say, hey, our international stocks, there's an opportunity for the right fund manager, and Drew's going to talk about how we vet the fund managers and kind of choose who we go with. But there's an opportunity to beat the market in those types of inefficient marketplaces where not everything's known immediately. And on the bond side of things, that's true as well, where we're using PIMCO for example, as a fund manager, or Smith Capital or ALPS, our biggest bond fund in most of your portfolios. Those are active managers picking individual securities or bonds that they believe can beat that particular market. So efficient market theory, we're using a combination of, hey, we know that this market is tough to beat, so we just want exposure there, and try to get a little extra bang for our buck by using actively managed funds in those less efficient markets. And this is a great way of looking at it. So we use a core satellite approach. All right, so in our models, we have a core set of holdings in those those efficient markets. Okay, so you can see in the middle there, core, you're going to have US large cap equities. Think about the S&P 500, the Dow Jones, the NASDAQ, right? So large cap equities. And we also have an allocation to mid and small size stocks as well, which are also primarily used with ETFs or index funds. Developed international equities and investment grade fixed income or investment grade bonds. Those are our core holdings. You're always going to have that type of an allocation. Okay, so we have, depending on the portfolio, the risk, the investment objective, the percentages towards those particular asset classes or allocations is going to be different based on your risk tolerance, but we're always going to have a certain amount of the portfolio in these core holdings. And then around that, depending on what we're seeing in the market, what we're seeing in the economy, we will use satellite holdings that we believe we can get a little extra bang for our buck, a little extra we call alpha. Okay, so for a given level of risk that you're taking, can we get excess return by using these types of holdings as satellite holdings? So for example, on the upper left-hand side, alternative type stocks or funds. Sector funds would be the next one down. We use a lot of different sector funds. So if we believe that, for example, the tech sector is going to do well over the next 6, 9, 12 months, that's a sector, we could find a fund that is directly investing in that sector. Okay, so technology, healthcare, financials, real estate, whatever it might be. Internally, as an investment committee, based on the data, we may say, okay, we want some exposure to this particular sector. Okay. Preferred stocks we are currently using, high yield fixed income we use. Bottom right-hand corner, we're going to talk more about these in a little bit, but the structured products have been a big value add for us, and using those as satellites in place of traditional bonds. But this is to the core of our philosophy. We have the modern portfolio theory driven by efficient markets, and then trying to get a little extra bang for our buck using the core satellite approach. All right, on a monthly basis, we're meeting. Okay, the investment committee gets together. We're actually doing it today. We're doing it this afternoon. So every month we get together, and this is a sample agenda of what we talk about. Okay, every month it's going to be a little bit different, but at least the first 4 or 5 bullet points on here are going to be consistent. We always review the economic data throughout the month. There's different data points that are being released that we track, and Drew's going to talk about it here in a little bit. We're going to give you a little bit of a snapshot about some of the economic data, how we digest it, what we think the impact's going to be on the market, those types of things. So we always review the economic data. We look at the broad index returns. We have a lot of indexes that we track. We want to see how the S&P is doing, how small and mid-sized stocks are doing, growth versus value, international stuff, different types of fixed income and bond indexes. So we want to know what the broad indexes are doing. So we review those. We review all of our models and how our models are performing over the last month, quarter, 6 months, 12 months, 3 years, 5 years, for example. So we're walking through the model performance. And then we go through the TFP model funds, so the individual funds in each model versus that fund's index. Okay, so for example, QQQs or large cap growth fund. Okay, it tracks the NASDAQ 100. We want to see how that's doing versus the growth index. Okay, and then we do that for every single fund and see how those particular holdings are doing. Okay, and then we have the TFP equity and fixed income model holdings. So we go through every model and see how the holdings are doing. And then we usually get into more specific topics for that month. For example, this one here, you can see a third from the bottom, fund watch list and fired list memos, and the client list for those particular funds. Let me explain that. And Drew's going to walk through an example this afternoon. We actually have a fund that we're going to vote on to replace in our models this afternoon. But we will review, hey, this particular fund has been on the watch list. Okay, we're going to go through our criteria here in a second, what gets you on our buy list. And if you don't meet that criteria over a certain period of time, you can get added to our watch list. And if you're on the watch list for a designated period of time and you don't meet the criteria to get back off of it, we will replace you. We will fire you. Okay, so a couple months ago, one of our funds was replaced. And when we do that, we send out a memo to everybody who holds that fund to say, hey, this particular fund no longer meets our criteria to remain in the model, and we are replacing it with XYZ fund. Okay, and so many of you have probably seen those memos come out, and that's what we do, just to inform you what's happening inside your portfolio and why we're doing it. So that happened. TLH list, second from the bottom there, tax loss harvesting. Drew's going to talk more about that here in a little bit. But throughout the year, for those taxable accounts, something that I think adds a lot of value to our clients is the fact that we are doing tax loss harvesting throughout the year, okay, to help you guys from a tax perspective. So we'll pull up the list saying, hey, these are the clients who have that ability this month to do some tax loss harvesting, and we'll talk about it as an investment committee and decide whether or not we want to pull the trigger on that. And then finally, from time to time, we're trying to get a wholesaler or one of the fund managers from the funds that we use to come in or join us via Zoom or whatever it might be to give us an update on that particular fund, particular asset class, for example, Smith Capital. is they manage our largest bond holding. Okay, so we wanted to know, hey, how's it going? Have you guys made any changes? And just as a fixed income manager, what's going on in the fixed income world? Give us some updates, give us your thoughts, give us the data that you're seeing and that we need to understand. So this is a sample agenda of the meetings that we have. We'll be doing one this afternoon, but this hopefully gives you an idea of what we're doing on a monthly basis when we get together. All right, I'm going to go through this slide and I'll hand it over to Drew here for a little bit. On the right-hand side, TFP model allocations. So we have built and manage 38 model allocations. Okay. There are plenty of accounts and clients who have custom allocations so that when we're managing their accounts based on their specific situation, or maybe they had an account with a bunch of gains and we can't sell everything at once and hit them with taxes, they may be off model, but the vast majority of people are in one of our models. We have 38 models, and you can see the different model allocations here. Traction FP models, there's 9 of them. It's typically reserved for accounts that are larger than 300,000. Okay. TFP strategic models, there's 9 of those. And those models are typically used for folks with an account that's 50,000 up to 300,000. Smaller model accounts, so the targeted models, there's 10 of those. And that's going to be most of the time for accounts less than 50. This isn't hard and fast rules. We absolutely can use different models with different amounts, but this is kind of the standard way that we look at it. We also have alternative strategies that are using commodities, private equity, private credit, hedge fund, those types of things. So for those clients who desire to have those types of strategies, or we think it makes sense from a planning perspective, we have 3 models for alternative strategies. And then from an annuity perspective, okay, Nationwide is a platform that we use for annuities. And to manage those, we built 7 models for those. Okay, now the models, I'll give you a snapshot here on the left-hand side. This is a look at just the Traction FP models. The top one is going to be for tax deferred, basically IRA type stuff. And the one below that is going to be for the taxable accounts. So you can see based on your risk tolerance and investment objective. So let's look at the top one. So Traction FP aggressive growth. Okay, the core allocation. Remember, back to modern portfolio theory, we have an asset allocation for every one of our models and every one of our risk tolerances. The core allocation is 95% stocks and 5% bonds or fixed income. All right. The current allocation matches the core. I'll give you an example here where there's a difference. But currently we say, yep, core allocation makes sense. We're going to have 95% in stocks, 5% fixed income. The equity range. So we are saying that for an aggressive growth model, we can go as low as 90% in stocks and as high as 100%, everything in stocks. Okay, again, the core allocation is 95, so right in the middle of that. But based on, again, what the investment committee determines is appropriate for that particular model and that asset allocation, we can move the equity range from 90 to 100. All right. The structured note allocation piece of this, okay, we use structured notes in place of fixed income or bonds the vast majority of the time. And currently there's the note allocation is 5%, which is all of the fixed income allocation because we're 95% stocks, 5% fixed income. We're doing all of our fixed income in the structured notes, which I'm going to talk about here in a little bit. Let's look at the third one down, Traction FP moderate growth. Okay, so the core allocation for a moderate type of investor in this model would be 60% stocks and 40% fixed income. Okay, the current allocation, where we currently are for that particular model, we are actually at 55% stocks and 45% fixed income. Okay, so we're a little bit less aggressive on the stock side of things. We're to the lowest range on the equity scales we can get, as you can see, just to the right of that, 55% to 65% in stocks. Okay, so instead of 60-40, we're 55-45. Part of that reasoning, and we sent this out via memo when we made that change, is that based on that particular risk tolerance and that asset allocation for clients with that investment objective, because of the way that fixed income is paying in terms of interest and yields, right? So they've actually become much more attractive the last 12 months than we've seen in a long time, to where interest rates, as the Fed started to increase interest rates, bonds started to pay more. Okay, and on the other side of that, as interest rates drop, as they've started to do, the Federal Reserve cut interest rates yesterday by 0.5%. When interest rates drop, the teeter-totter effect means that bond prices go up. So we're getting paid more on our bonds. And also there's a chance for higher appreciation. That's why we wanted some more allocation on the bond side of things. The risk of taking on the 60% stocks versus 55 is pretty negligible, but the opportunity to get better returns in bonds, we found that was enticing and appropriate. And so that's why we made that change. So there's an example of where we're a little bit off of our core allocation, not by much, but that's something internally as an investment committee we're talking about. Do we want to be back to our core allocation? Do we want to make changes, maybe get a little bit more aggressive, a little more conservative? Those are the types of things we're doing internally when it comes to the models and the allocations there. Bottom right-hand corner, we do rebalance our accounts. Okay, we're big fans of rebalancing. So what's that? What does that mean? If you have a allocation of 75% stocks and 25% bonds, like the second one down, which is the Traction FP Growth, and let's say over the last 6 months, stocks have done really well. So now we're at 80% stocks, maybe 83% stocks, and our bond percentage has dropped comparatively because stocks have done so well. That's awesome. But what we want to do is make sure we capture those gains. Okay, you want to buy low and sell high. So we're going to capture those gains. If it was 83% in stocks, we want to take that 8%, get us back down to 75, and purchase back into bonds to get us back to our 75-25. Okay, that's how you make money over time. You don't want to be the ones who wait until you buy high and you sell low. That's the opposite of what we want to do. So rebalancing allows us to capture gains along the way. And back to the bottom right-hand corner, in our tax deferred models, so basically the Roth IRAs, the IRAs, SEP IRAs, if you have a 401k with us, to where when we do our rebalancing, it doesn't trigger capital gains. There's no tax consequences for selling a gain because everything's tax deferred until the money comes out. We rebalance twice a year. All right. The taxable models, we have to be more careful with. So we're rebalancing the taxable models typically one time a year. And we may be doing some tax loss harvesting throughout the year, making trades outside of it, but a full rebalance is going to be one time a year to make sure that we aren't hitting people with taxes that shouldn't be realized at the time, as opposed to the tax deferred models when we don't have to worry about that. I'm going to pass it on to Drew, and he's going to continue talking about our buy list and watch list and ideas list and how we come up with those.
All right, thank you, Evan. And I apologize. I forgot to mention on the during the intro that we will do Q&A at the end. If anyone does have questions, you can enter questions into the Q&A chat box. So any questions you have, feel free to throw those in that Q&A box, and we'll get to those at the end of today's presentation. But back to our buy list, watch list, and ideas list. So within our investment committee, we maintain and analyze a buy list. A buy list is all the mutual funds and ETFs that meet the specific criteria that the committee has in place to warrant being on our buy list. So Evan mentioned that we, in our committee meetings, really dive into how our models are performing and how the model funds are performing. So of course, all of our model funds are on our buy list, but we certainly have other funds that meet the criteria that we have in our buy list as well. We normally kind of think about it as kind of our top picks of our buy list are what make it into our models. So the criteria required to get onto our buy list here in the box on the left-hand side. First and foremost, we need the fund to have at a minimum of 5-year history. It needs to have been around for at least 5 years. There's constantly new funds and ETFs being launched, and they might be new and exciting and might look like the best fund to get new money into. However, when it comes to managing money for the long term in order to meet one's goals, we have to have a track record. So we need to see that these managers and these funds have been able to perform through more or less a full cycle, full economic and market cycle, which is kind of that 5-year mark. So you will not make it to our buy list if you don't have a 5-year history. The second bullet point here is there is specific criteria when it comes to performance, particularly related to how that fund does relative to other funds within its specific category or asset class. So, I'll mention a handful on a slide here in a moment. But some of that specific criteria is, it's not just what was your return last year compared to the S&P 500. If you're a small cap value fund and the small cap value index is doing, call it 10% better or 10% worse than the S&P 500, we're not comparing it to that. We need our small cap value fund to do well within the small cap value arena. So we're comparing performance metrics within the specific asset class or sector or whatever it may be relative to its competitors in that space. And so, it's something we're tracking, in our monthly meetings. And if you're starting to not meet that criteria, as Evan mentioned, that's what can get you moved to our watch list, which we'll dive into in a moment. Reasonable expense ratio. So what is the internal cost of the fund? It's not necessarily a hard and fast rule of the committee that you be in the top half of cost efficiency. We'd like you to be. If you're a little more expensive of a fund, but you're consistently delivering outperformance in your category, we're certainly willing to hire that fund. But again, that's why we have to have that track record of proven performance and proven outperformance. So generally speaking, we need the fund within its particular category to be in the top half in terms of cost effectiveness. Tax efficiency. So, tax efficiency really is important, particularly when we're thinking about funds that are going to be in our taxable accounts. So, your individual accounts, your joint accounts, your trust accounts, those types of accounts that we're investing that are outside of the retirement accounts. We don't want to have any kind of phantom income created. So phantom income is effectively if the fund is not tax efficient, it's required to push out any capital gains to the mutual fund shareholder. So, or ETF can do it as well, even though they're more tax efficient generally. So if at the end of the year, the fund's performed relatively well, but it pays out a capital gain distribution that you owe tax on, even though you didn't sell the fund, that's lowering your after-tax return. So our goal as, wealth managers is to provide the highest quality at the lowest cost possible to give you the highest after-tax returns possible. So there's all these variables that go into it. Tax efficiency is crucial when it comes to holdings that are going to be in our taxable accounts. Comparison of alpha to its best fit index. So alpha, as Evan mentioned earlier, is what is your expected return and are you providing excess return relative to what the expectation is? So if you're most, from a best fit index, if your best fit index is the S&P 500, but you've consistently been able to outperform the S&P 500, that means you're delivering positive alpha. If you're underperforming, you're delivering negative alpha. And so it really has to be an actively managed fund for alpha to be a relevant measurement. Because if you're an S&P 500 fund, your goal is just to match the S&P 500, and there's a little bit of an expense there. So we would expect an S&P 500 fund or ETF to actually have very slightly negative alpha because it should match the index minus its fee. But if you're an actively managed fund, we want to hire you if you can deliver alpha, if you can give us excess returns. So we want to see a positive alpha for funds like that. For satellite funds, as Evan mentioned, the core holdings within the models in our client portfolios, the vast majority of that's going to be in those core holdings. But we're going to put some satellite funds around it, again, to, on our end, try to deliver some alpha or to reduce risk, whatever we feel might be most appropriate. So for those satellite funds to be on our buy list, it has to meet all the same criteria I just spoke about. And whether or not we're going to actually utilize those within our models depends on the economic and market environment that we are constantly tracking to say, okay, we think that this sector or preferred stocks, which we do have preferred stocks in our models right now, and they're having a really fabulous year, that they're well positioned to be able to be added to the models given where we are in an economic cycle or a market cycle. And it's not an absolute requirement, but we really like to see the fund manager invest their personal assets in the fund that they're managing, eating their own cooking, so to speak. And we do the same thing here at Traction Financial Partners ourselves. Our personal portfolios are invested in these same buy list funds. They're invested in these same models. We believe that if it's the best things for our clients, it's the best things for us. So we're aligned in how we invest. And we want the mutual fund manager or if it's an ETF, we want them to have that same kind of buy-in. If your own money, your own capital is on the line, you're going to have conviction in the way you're managing that portfolio. And so we really prefer to see that fund manager investing personally in the fund, normally to a tune of at least $1 million of their personal funds. So that's kind of a rundown of what gets you onto the buy list. Now, if you start missing the metrics that are required to be on our buy list, we're going to move you to our watch list if certain triggers are met. And so it's effectively moving these funds into timeout. And when a fund is on a watch list, we're not adding any new money to that fund. So we have, as I mentioned earlier, our buy list is not just what's in our models, but if a model fund goes to a watch list, we have an alternative that we can add new money in that same sector or that same asset class. So no new money gets added to that. So if someone sells a property and invests the proceeds or rolls over a 401k, we're not going to put any new money to invest into a watch list fund. Now, some examples of what gets you onto the watch list is lagging performance metrics based off of, again, the metrics we have in place as a committee. Particularly if you're an active fund managers leave from time to time. And if you leave, if there's a fund manager with a proven track record of managing a fund and they leave to either go somewhere else or they retire, well, we don't know we don't have a track record of the new manager. So that's going to automatically put you on the watch list so that we can take some time to really see how this new manager is going to be able to manage the fund. And poor tax efficiency. So, if you're just constantly paying out these capital gain distributions and causing the shareholders to pay tax on funds they're not selling, if we can find a fund with similar or better performance that's more tax efficient, we're going to want to use that alternative, and that'll get you on the watch list. So, and again, there's exceptions that can apply. Normally, when you move to the watch list, we give you a year to kind of get your act together, to earn your way back onto the buy list. Now, there's exceptions, as I mentioned, to where we'll either extend it, or if things, get so bad, we may accelerate that 1 year. But generally, we give you a year to kind of get it back together, because every fund cannot be a top performer every single year. There's going to be down years. And that doesn't mean we automatically want to fire you or replace you as a fund. We'll put you on the watch list and see how you navigate that period of time, and if you can come out of it and earn your way back. And then we also have an ideas list. An ideas list is really just a list that we keep track of for funds that are not yet on our buy list or in our client portfolios, but we find them to be appealing and we want to track them for a little bit to see how they do, to see if it warrants adding them to the buy list. So, economic and market indicators suggest there may be a good time to allocate to a particular area. And so we may have a fund in that area on our ideas list just to see how it's performing, particularly alternative types of investments. They're not as widely used in our client portfolio. So if there's some appeal to potentially using one, we'll normally put that on the ideas list to watch it for a while before we actually get it to the buy list. Or if there is a new fund that I mentioned that we do think is appealing, but it hasn't yet hit that 5-year history mark, we'll put it on the ideas list, see how it does for its first handful of years. And once it hits its 5-year mark, if it's still appealing and meeting our metrics, we then may move it to the watch list. So here's how we, kind of analyze and manage the specific funds that we do put into our models and into our client portfolios. Now, in terms of resources and what the committee uses to do our due diligence, first and foremost, LPL Financial, which is our custodian where your accounts as our clients are held, their research department puts out a lot of good economic and market data. They have specialists doing daily calls to give updates on a lot of different things. They're putting out a weekly research paper and report. So we're definitely utilizing them as a resource. Morningstar Advisor Workstation. This is our main resource to do the due diligence on the specific funds themselves. So our watch list, our buy list, all of that is maintained within Morningstar. It gives us all the performance metrics and all the risk metrics and tax efficiency metrics that we want to be able to analyze for the specific funds. It allows us to see that and how those funds are ranking against their competitors. JP Morgan Asset Management puts out good economic and market data that we use a lot in our quarterly market and economic webinars. If you tune into those, a lot of that data is coming from JP Morgan and First Trust portfolios. So we lean on First Trust a lot for our economic data. We lean on JP Morgan a lot for our market data. And then, Smith Capital, as Evan mentioned, they manage the primary bond fund that we utilize. And they put out a lot of good research paper, particularly in the fixed income area that we like to utilize. And then Orion is our asset management platform. It's how we trade. It's how we rebalance portfolios. Ev mentioned tax loss harvesting lists. So if there's funds that slip to a tax loss in a taxable account for clients, it pings us so that we can review that. And if we are going to swap any funds out, it's just a really great tool. We can swap funds out across all client portfolios in a matter of minutes. So it's a great tool for us that we utilize for trading. And then you can see there at the bottom, and I've mentioned it earlier, we're frequently meeting with representatives from the fund companies that we utilize, even the portfolio managers themselves, to do deep dives into the funds and how the funds are positioned and what they are forecasting for things moving forward. So just to give you an idea of a lot of the resources that we're utilizing. Okay, so a Morningstar fund analysis, and this is a little small, so I apologize, but we wanted to give you a direct example of a fund that meets the criteria to be on our buy list and a fund that's on our watch list and potentially, if not likely, to be replaced. And the specific fund on the right, we're actually voting on this afternoon, as Evan mentioned earlier. So if we look at these bars across the bottom here, this is how has the fund performed in a given year. There's 4 little quadrants there. So you can see, we want to be on the top half. If you're in the very top bar, like we are in this year, you are a top quartile fund. So you're in the top 25% of funds in that category. The second one is 25 to 50%, 50 to 75, and then the bottom quartile. So we want to see at least an 80% batting average, if that makes sense. So we normally track that 5-year period because, again, it's a full cycle. So 4 out of 5 years, we want to see that you're in the top half. And so this buy list fund, the Invesco S&P Midcap Quality ETF, so it invests in midcap stocks that have an emphasis of quality, quality of balance sheets and earnings and things like that. You can see here over the last 5 years, it meets that 4 out of 5. It did have one down year. So we mentioned funds do have down years, but it's done quite well. And then we look at the trailing periods. Okay, so this is how it's done the last 1 year relative to its competitors. It's in the top decile in all of these periods. So in the last 1 year, it's in the top 7% of funds. The last 3 years, it's in the top 3%. The last 5 years, it is the best in the category. The last 10 years, it's number 2. So we're looking at how you're doing on a year-by-year basis, and then how that equates into trailing returns. Now, this fund, which has been on our watch list, last year, it slipped down to make it to where 2 out of the last 5 years, it has been in the bottom half of funds in that category. This is a small cap blend fund. And so that doesn't automatically trigger you going to the watch list in and of itself. We want to see how that affects, because you might be 50th and 51st here and then do really well in the other years. So we look at the trailing years. So the trailing returns and how that ranks in the category. The last 1 year, it's been the 94th percentile. The last 3 years, 87th. And then the last 5 years, 58th. So for us, and it's also lagging a bit this year as well, to where this 5-year number will probably get worse as well. So to us, this tells us, okay, we've given you plenty of time. You've been on the watch list for about a year now. Your metrics have not risen to the level where you've earned your way back onto the buy list. So we're going to explore alternatives, and we're going to take a vote to see whether or not you're going to remain on the buy list. Okay, so when it comes to changes to the TFP models, our process is pretty straightforward. All changes to the models will be presented to the committee during one of our monthly committee meetings by the chair, which is Evan. That does not mean that Evan is the only one who can suggest changes. Anyone on the committee can. They will just take it to Evan, and then Evan will present it and potential alternatives. These changes could include, but are not limited to, whether or not we're going to change a fund within our models, or whether we're going to, as Evan showed us, our model allocations, if we're going to take our neutral allocation and move it 5% one way or the other. So these are the types of things that the committee will bring to a vote, which if the majority of the committee members vote to approve whatever the suggested change may be, we will then move forward with that change, and then we will send a memo to all clients that are affected by that change. So if we're making an allocation change to our our Traction Financial Partners growth model, and you're in our growth model, you'll get a memo with whatever that change may be. So we want to consistently be communicating to you that, hey, we're on top of things, we're tracking things, here's a change we feel is going to be in your best interest, so that way you're always up to speed with what's going on in your portfolios. Okay, so we thought it might be there's a lot going on here, and we're not going to take too much time and dive deep into all these various metrics, but we wanted to give you a sample of some of the economic data and measurements that we're constantly tracking, and then really what that means to us. So you can see here, we've got what we consider to be lagging indicators. So GDP, wage growth, non-farm payrolls, which is kind of the jobs report, how many jobs were added for the last month. CPI, the Consumer Price Index, that's the rate of inflation. Existing home sales, new home sales, from an earnings perspective, what's revenue growth, earnings per share growth, and then your beat percentage. So a company will say, hey, we expect to earn this much for the quarter, and are they beating that? And so we'll look at what the previously reported data. Most of these come out monthly. These come out quarterly since companies report earnings on a quarterly basis. So what is the previously reported? What's the most recent? So that way we can start to see trends. And then we in our committee say, okay, what's our, did that meet or beat what the expectations were that were forecast by the economists or the market folks that are putting out earnings expectations. And then we say in our committee, okay, what does this mean to us as investors? Is this positive? We think, this particular is kind of neutral, but it leans positive, or this is kind of neutral, but it leans negative, or this doesn't really move the market one way or the other. Or, back in 2022 when inflation was raging, if we got an inflation report that was below expectations, that was clearly a positive for the market because that meant the Fed may not raise interest rates as much. And then any specific notes that can provide additional context. And this is certainly not everything we're monitoring, but just kind of an example. And down here, we have some additional things that we like to make sure we're staying on top of. So with that, we'll get into tax management. So tax management, as we've kind of mentioned a few times throughout today's discussion, it's crucial. Our goal is to give you the highest after-tax return. So one of those things is called asset location. Asset location, not asset allocation, but location is what investments are going inside of specific account types. So for assets that are in the taxable environment, we want them to be very tax efficient. For retirement accounts where, you're not paying tax on whatever the investments are producing within the account, we don't need to be as efficient as tax efficient in those types of approaches. And then as Evan mentioned, we definitely do tax loss harvesting at a minimum on a quarterly basis. In reality, probably even a little more frequently than that, so that we can stay on top of it and capture any meaningful losses. And for those of you who aren't super familiar with tax loss harvesting, it's when we're intentionally selling a position in a taxable account that has fallen to a capital loss. So we will sell that fund, book the capital loss for tax purposes, and immediately move the proceeds to a fund in that same category. So that way we remain allocated to the areas we want to be. So for an example here, if we have a large cap growth fund A that we bought for 10,000, a few months later, it's lost 50%. So now it's worth 5,000. We will sell large cap growth fund A, move it to large cap growth fund B so that we remain invested in the large cap growth area. We book a $5,000 loss for tax purposes. And let's say by the end of the year, is a very volatile year in this example, but by the end of the year, large cap growth fund B has recovered 100% of the losses. It's now back to 10%. The result, you as the investor did not lose any value in your large cap growth holdings. However, we were able to realize 5,000 in capital losses, and those can offset capital gains if we have any capital gains from any other sales, or if there are no capital gains, the IRS allows you to take 3,000 of those losses to offset ordinary income, and whatever's left carries forward with us indefinitely. So 2022, for example, when the markets were down, we were doing a ton of tax loss harvesting. Way more losses were captured than could be used to offset gains. And so the market fully recovered in 2023 and went on to new highs. It's gone forward, of course, again, this year in 2024, and most of our clients with those taxable accounts still have a lot of losses that we can utilize to offset gains. So that's just an example of how we're always very, very focused on trying to manage in a very, very tax efficient way your portfolios. And finally, with that, I'll kick it back to Evan to wrap us up with our unique allocation solutions, primarily structured notes and how they operate.
Thank you, Drew. That was awesome. Okay, most of you hopefully are familiar with structured notes, and we've been using them for a decade now. but have become very, very popular with us and how we use them inside of your portfolios, in particular in place of bonds. We don't use structured notes in place of all of your bonds, but we use it for a certain percentage of the bond allocation. As I was showing you before on our model allocation spreadsheet, we have a certain amount that we set aside for structured notes. Over the last few years, especially when it comes to the bond world and interest rates going up, bond prices going down, it's been tough for bonds. So we've been using these structured notes. This is a little bit cumbersome, kind of how I put this together. I apologize, but this is an example of a structured note. And it's a 3 year, so you can see under the term area there, 3 years. Okay, so it's like a CD or a bond. There's a 3-year time period on it. The protection right next to it, there's a 50, on this particular note, we got 50% downside protection. So those indexes on the left-hand side there, the NASDAQ, the Russell, or the small cap value index, those are all indexes that this note tracks. As long as none of those notes were below 50% down, 3 years later, you were going to get all of your principal back. Okay, and at this point, we had really nice coupon payments. Over to the right, there was as 9.5% was the annual coupon payment, which is really attractive, especially when bonds were super low and not paying anything before interest rates started to go up. And as long as the worst performing index is doing better than whatever this protection is, which is 65%, basically a 35% drop, we were still getting our coupon payments. We are going to capture a lot of income along the way with a lot of protection. So this one just got called matured, and in the middle under the note performance, total coupons earned, we made 20.584%. Worked really well for us over that time from the middle of 2022 until it just getting called a month ago. I don't have it in front of me here, but the bond index was definitely negative over that time period. So we have performed by 20% or more. So these have been very valuable. And on the graph here that Drew is highlighting now, the payment graph, you can see it just shows you that the coupons are paid on a monthly basis, assuming that the worst performing index is not down more than the barrier that we set. If it is, all you do is miss a coupon payment. So an example there was below the barrier and missed 2 consecutive coupon payments, but as it creeped back up, you started to get your payments towards the end there. This particular note didn't miss any coupon payments, but it has happened from time to time. The best thing is that the principal is protected all the way through 3 years, and it only matters on the date of maturity where the worst performing index is. It's very unlikely over a 3-year time period for one of those indexes in this particular scenario to be down more than 50%. It's almost unheard of. Okay, we're running out of time, so I went through that quickly. Hopefully you guys are very familiar with the structured notes, and we're doing a good job of explaining this to you as we get together for reviews. But these have been very impactful. And I believe that is the last slide. There are 2 Q&As in there. I wanted to get to those real quick. Drew, you want to read those off real quick and we'll see.
All right. So this first question, they say it's been an excellent presentation. So thank you for that. Glad you found it informational. The question: with 6 experienced advisors with differing backgrounds, is there ever legitimate disagreement on those important monthly decisions? If so, how do we resolve them? And move forward with the best decision for clients. So, I mean, what a wonderful question.
Yeah, it is. It's not a question.
I'll let you take that.
Yeah, I mean, I'd say almost every meeting we have some type of, not necessarily disagreement, but just someone throwing out, hey, do you believe that we should continue to have this particular allocation to U.S. stocks versus international stocks, right? U.S. stocks have outperformed for years now. We believe in broad diversification, so we always have some exposure to international stocks, but we had a detailed and fairly spirited conversation a couple of months ago around, do we want to continue to have as much allocation internationally as we currently do? And so we are bringing that back to the committee again to say, all right, here's our thoughts, here's some research, here's how we come up with a decision. And again, we may not be unanimous, but for the most part, I think we do come to some type of a compromise or to an agreement. And but I would prefer it this way, where we're not agreeing on everything. We better not. because then we're not being critical thinkers and we're not doing a good job for our clients. So I think that's a fantastic question. It happens constantly where we do not agree on everything.
Yeah, and I would add that when it comes down to significant changes, it really boils down to a vote. You're right. So there's 6 members, and some of them are going to disagree. It's whoever has the majority is going to win out on that. So we effectively settle it with a vote, because we know that more heads are better than one, right? And so with the experience we have on the committee, if you win 4-2, even if you're in the 2, we move forward with the majority decision, and that's how it's settled. Okay, and then the last question here: with the Fed finally cutting rates by 50 basis points or 0.5%, how does that impact the models with a signal that more cuts may be coming? And they certainly did signal that more cuts are coming. I think they expected another 50 basis points by the end of the year. Again, we'll see. They're data dependent, so we'll see what data comes along the pike for the last few months of the year to see what they do. But I think when Evan was sharing the allocation of our models, I think it does not bring us any immediate changes. Our committee is trying to consistently get ahead of things, right? So part of why our moderate growth and our income with moderate growth models, kind of those two balanced areas, we are underweight to our neutral stock position by 5%, is in anticipation of these Fed rate cuts, knowing that as the Fed cuts rates and rates trend down, bond prices go up. So we're able to maintain a similar return profile with actually taking a little bit of risk off the table. So really, I think we're positioned where we want to be.
And then the opposite side of that is with rates dropping, risk on assets, meaning stocks, tend to do better. And so that's why with the more aggressive and the growth-oriented allocations, we kept those in our core allocation, right? We didn't get more conservative with those because those should do better in a drop in interest rate environment from stocks increasing, right? While those folks who are more moderate or more conservative, it made more sense to do what Drew said is we can lower our risk profile and still maintaining returns on the bond side of things. So that's a great question. The market obviously wants interest rates to drop. The question is, are interest rates going to be dropping because the economy is slowing to a point where we might be flirting with a recession, or are they going to accomplish a soft landing? All stuff we're talking about today in our meeting. But that's a great question.
Yeah. And there's no other questions that have come in. So this webinar is recorded, and we will be sending an email out with that recording. So keep your eyes out for that if you want to revisit anything we discussed today, or if you want to pass that along to anyone you think may benefit from it. With the market being up nearly 2% today, we may have to do an investment committee webinar on a weekly basis.
Yeah, see you guys tomorrow.
With that, thank you so much for your time. We know how valuable it is. So thank you very much for joining us. As always, if there's any questions, reach out to anyone on the team, and we'll be sure to help you. So thank you so much, and we'll see you next time.
Thank you.